Zaheer, can you hear me? Hello, hello.
Hi guys, how you doing?
Good. Where are you broadcasting from today, Zaheer?
I'm broadcasting from London, UK.
Oh, good for you. Well, go out and have a pint of bitter for me at the local pub. Uh, we see your PowerPoint is up. Our first speaker this morning is Zaheer Anwari. Zaheer is the co-founder of Sub SublimeTrading.io and the Revacy Fund, an alternative multi-asset fund. With nearly 2 decades of investing and mentoring experience, his mission is simply to equip you with strategies that not only grow your wealth, but safeguard it as well. Please welcome Zaheer for his presentation on how to make 30% plus a year by consistently finding and compounding high performing stocks. Okay, Zaheer, I'm going to go ahead and mute myself, and you have the floor.
Lovely, thank you. I'll just do a screen share. Can I just get confirmation that you can see my slides?
Yeah, how to make 30% a year consistently finding is what I
Brilliant, thank
see
you.
with a
Fantastic.
with a chart that's going up and to the right.
Absolutely, the way we like it.
Okay,
Brilliant,
I'm muting myself. You have the floor until 5 minutes before.
brilliant. Thank you very much. Hi guys, I'm really honored to be starting the day as the first speaker. I just want to say thank you to everyone in the team. And congratulations as well on this being the 25th anniversary, the silver edition. So, fantastic. I hope I have an equally long and illustrious career as well as John. So, thank you again. Okay, so let's dive straight in. How to make 30% a year by consistently finding and compounding high performing stocks. We're going to go through a proven rules based process for serious investors. Now, most investors are drowning in opinions, market calls, stock tips, crash warnings, AI hype, recession fears. Ultimately, it's a lot of noise dressed up as insight. You go online, you go onto social media, and it is absolute chaos. This session today is about process. It's not about predictions. It's about using the Sublime Trading portfolio process to identify high performing stocks and assets with repeatable rules. And I think that's something really, really important. The reason why people give up a lot is because they don't have a process that they can stick to. They're always bouncing around between one strategy to another because there really is no structure to the way people are approaching things. So we want to change that. No day trading, no top calling, no predictions. A rules based process for finding strength, managing risk, and letting winning assets compound. Now, look, I'm people who know me on social media know that I'm quite vocal about avoiding day trading. If you are day trading, by all means, go ahead and do your day trading, but you don't want to rely on it as a sole income or sole way of generating wealth. You're going to be left disappointed. What you want is two portfolios running side by side. If you want to have your day trading portfolio, by all means go ahead, but you've got to have smarter, longer term processes as well work in the background, and that involves compounding, because ultimately compounding really is that secret sauce to wealth creation. My personal goal has always been to put trend following back where it belongs. While most investors jump between cheap stocks, hot tips, day trading, and market predictions, we focus on trend following, the process that has built serious wealth for decades. If you look at performance tables, you will almost always find trend followers at the top of performance tables. You look mid table, and it's usually value investors. Yet when you go online, value investing gets a lot more attention, and that didn't really sit well with me. Trend following made a lot more sense. It was a lot simpler, and also a lot more profitable. So why doesn't it get the attention that it deserves? And so that really was my goal, to put trend following back in the limelight. Now, where it began for me, this process was built from frustration. I was tired of shiny objects, weak returns, conflicting opinions, and strategies that look clever but fail to compound capital properly. So we built the process we wish we had when we started back in 2007. So, it was a real struggle in the early days, trying to find good information, a lot of over promising and under delivering, a lot of expensive courses, a lot of scams, and ultimately that's just got worse and worse and worse over the years. Especially now that we're in this sort of information age, it's really hard to find the right information. So the skills that people need today is not so much about finding information, it's about filtering out that information and narrowing down to what actually works and what matters. And so hopefully this presentation will give you a really different insight. So who built this process? Who am I? My name is Zaheer Anwari. I've been trend following since 2007. I've got a degree in software engineering, which really fueled my love for the trading technology and the tools that I have built. I didn't really pursue a career in it. I worked for Oracle as a software engineer for a year, but I didn't really enjoy it. I quit. I then became a TEFL teacher. So I was teaching English on and off for 10 years. I lived in Taiwan, Japan, Philippines, here in the UK as well. There are a lot of English language colleges. So, in my 20s, I was working in schools and teaching English, and that really shaped the ability for me to then transition into the mentor. So teaching English to mentoring people with their money and building portfolios. I personally built wealth through photography. So after I came back from Taiwan and I was still teaching English part-time, I actually then worked in photography side by side. And it was in photography that I started making good money because our images went on the side of buses. We were working in advertising photography. And I learned a lot from photography because I learned about the equipment and the importance of good camera. I mean, our images went on the side of buses. So we had to make sure that the cameras that we were using, which was a Hasselblad medium format camera, the images came out without any pixelization. So, I learned a lot about the various careers that I was in, and that all sort of transitioned me and helped me build the businesses that I have today. Excuse me. I co-founded Sublime Trading in 2018 and then the Reversy Fund in 2023. And this has all been built on the process to turn professional trend following decisions into a clear, usable portfolio workflow. These are all the wonderful publications that I've been able to share my message across. Last year was my first time with John and the guys at the Mad Hedge Fund Trader events, and so this is the second year I'm doing it, which is, as I said, a great honor. But I've also been a guest speaker. I've contributed to all of these other wonderful publications. Recently this year I've appeared in the Wall Street Journal and the Khaleej Times as well, which, if you aren't familiar with, is a very popular publication in the Middle East, kind of like their Financial Times. So the message is getting out there and people are starting to listen to what I have to say, which is, great. It's a lot of hard work and time and energy to get to where I am today. So we apply this process across everything we do. Sublime Trading, which is investor education, portfolio training, and the copy service support that we have, and the Reversy Fund, which is portfolio management built around the same trend following philosophy. So we've got something for everyone. If you want to learn to do it, we can show you how to do it. If you want a fund management service that will get you far better than the average fund, then absolutely we've got that for you as well. And again, both follow the same workflow. So today I'm going to show you why most investors struggle to build real market wealth, how we reduce thousands of assets into a focused short list of leaders, how we identify the highest quality opportunities before capital is committed, how a rules-based trend following process turns analysis into portfolio execution. Now, this process is not just theory. It's a repeatable portfolio process you can follow, refine, and eventually pass on. And this is really important because the careers that we're in, the schooling system is designed for building careers. It's great for building careers. But once you go out into the big bad world of employment, we are all faced with the same challenges, which is, what do we do with our money? The only difference is that, we're all dealing with different sums of money. But ultimately, we all face the same challenges, which is, what do we do with it? How do we save? How do we budget? How do we invest? How do we compound? There's just so much that we need to learn and understand. And then not only that, you want to learn a system that's repeatable that you can then pass down to your kids and loved ones, because that financial illiteracy loop that we're kept in, that has to be broken. So this is a system for building wealth with rules, not opinions, designed to turn ordinary portfolios into extraordinary legacy portfolios so that your kids can carry on the good work. And as I said, this is not just theory. We've got a hedge fund off the back of this. And because we've got a hedge fund, we've got an audited track record that goes back to 2016 that comes in at over 30% a year. So this is all based on evidence and facts, not just back-tested theory. So let's just look at some returns and why you should consider doing this. Let's say you have two portfolios running side by side. You have the S&P 500, you have $20,000 in a tracker fund, and then you have $20,000 in an account that allows you to invest in stocks that outperform the market average. Let's say you have a 20-year time horizon for both. You add an additional $100 a month. Let's say you get 11% a year. I feel that's a little bit generous with a tracker fund, but let's say you get 11% a year. With what we do, let's say 30% a year. You can see the difference there, guys. With an S&P 500 tracker fund, you're looking at around $250,000, which, in isolation, you look at it on its own, 20K to $250,000, it's a decent return. But then again, you have to think about your retirement. 20 years of retirement, is that going to last you and give you a good retirement? Very unlikely. 30% a year with the same figures, you're pushing your returns to over $4.5 million, and $4.5 million. That is true wealth creation. And not only have you built the wealth, you've also learned a set of skills to do that. And that is what I'm talking about in terms of passing that down to your kids and loved ones. So the difference is not just activity. The difference is process, asset selection, and compounding. So we have a copy service as part of Sublime Trading, and that's based on a 20K account. £20,000, $20,000, same thing, 20,000 euros. It's based on 20K. That portfolio has grown by 275% since February 2023. So just over 3 years now, and we've seen a return of 275%. So this goes to show you the power of holding and compounding winning assets outperforming the index. So why most investors never build real wealth from the markets? They do not lack information. They lack a repeatable process that survives noise, emotion, and changing market conditions. So mistake number one, they chase tips instead of tracking strength. A tip gives you a name. Someone can easily go out there and say, hey, you should buy this stock. We hear it a lot. But the performance of that stock gives you a lot more information. So we have to look away from the tip. It's just a name. Instead, we have to be able to analyze that stock and decide whether it's showing strength or not. So strength gives you evidence. Evidence can be scanned, it can be filtered, it can be ranked and acted on. So you can have 10 stocks all showing you strength. We then want to be able to look at those 10 stocks and literally narrow down to the best. So there is a process to this. Mistake number two, they react to headlines instead of following evidence. Headlines explain what has already happened. Price action shows you where capital is moving now. And we see that a lot. We can go back to March when there was a correction and everyone was saying, hey, the market is coming, we're going to see 1930s all over again. Another market crash is about to happen. April, there was a complete recovery and new all-time highs in the indices. We saw that last year when the Trump tariff saga was going on at the start of the year. Everyone was saying, hey, market crash. Look at where we are today. And that's all down to the headlines and what's happening on social media. It's just designed to fearmonger and get people on the wrong side of the trade. If you turn all of that off and focus on the charts, you will make better decisions. You'll stay aligned with the market and ultimately you'll make more money. And so that's really what this is about. Mistake three, they confuse activity with progress. More charts. You see that all the time. You see people with, 5 screens, 6 screens, all with different charts and different time frames. More alerts kicking off, more trades going off. People over trade. You know the expressions, guys. Trade well, not often. Right? It's timeless. These are timeless mantras. More opinions. One of the first rules of investing is to ignore opinions, including your own. Opinions will always get you on the wrong side of the market. The markets tell you what you need to know. You then want to react accordingly. And after all of that information, there's still no edge. Now, what is an edge? An edge is ultimately where you have more chance of making profit than a loss. Here's the thing, guys. If you cannot define your edge, you don't have one. And if you don't have an edge, you will get eaten by someone who does. And so if you're constantly finding yourself on the losing side, that means you lack an edge. And you're losing money out, you're losing out to someone who doesn't have an edge. We need to turn that around. Mistake number 4, they buy weakness and sell strength. Most investors are trained to hunt for bargains, cheap stocks, discounted stocks, undervalued stories, but the market often rewards the opposite. Strength that keeps getting stronger. We've particularly seen that since 2009. We've been in this massive bull run. And so it's really the last 3 years, 4 years, 5 years where the market has just kept on getting stronger and stronger and stronger and stronger. And those who end up looking for cheap stocks usually end up buying falling knives because the money has moved from one sector to another. There's this rotation process that's been going on for the last decade that people are getting caught out on. So we want to stay aligned with the market and we want to focus on strength. Buy strength, sell when strength fades, instead of doing the opposite. So the crowd wants certainty, but the market rewards alignment. Strong market conditions, that's what we're looking for. How do we do that? We'll look at that in a second. We then want the strongest sectors. We've got 11 sectors. Yet all we ever seem to hear about is the tech sector. People forget about the other 10 sectors. We always want to find the strongest stocks, the strongest sectors, and then we want to find the strongest stocks in the strongest sectors. You can see how we're continuously building on top of each other. This is what I'm talking about in terms of an edge and a process. We want to start with the right market conditions. Is the market bullish? Okay, yes, it is bullish. We then want to go and look at the sectors. Which is the strongest sectors? Okay, these two sectors are showing the most strength. Okay, then let's look at the stocks in those sectors. Let's find the strongest stocks in those sectors and let's invest in those for the next 12 to 18 months. That's the kind of process that you want to have. You then want to be looking at the strongest trends among the strongest stocks. Clear rules and nonchalantly follow. This is really, really important. You want to do this like you just do it. Just like you brush your teeth or, you hopefully get changed in the morning and leave the house. How you do those things that we do day to day that are just what we do. This is how you want to manage your portfolio. You just do it because you do it. You don't want to overthink it. You don't want to use this as a hobby. You do it because it's just part of your routine. And once you have that instilled in your routine, results absolutely change. And again, it goes back to what I was saying. You want to trade well, but not often. Just because this is part of your daily routine doesn't mean that you're actually taking positions every single day. It just means that you're aware of what the market is doing. And sometimes you just need to stand aside. Remember, standing aside is also a position, right? Okay, so most investors start with a ticker. That is a huge mistake. A ticker without market sector and trend context is just a name on a chart. Our edge starts before the asset pick. The goal is not to predict the next move. The goal is to build a portfolio around strength and manage it with rules. So we want to have a flow. We want to start with the market. We want to start with the sector, the asset, the setup. Then we want the entry. We want the stop loss. We want the risk. We then want to be able to compound the winners. And then we want to exit using some kind of trailing stop loss. So there is a structure and a process that goes from A to B to C all the way through to the end, ultimately from entry to exit. So this is where the process becomes practical, not as a theory, as a filtering, ranking, and decision support workflow for serious investors. An asset is never analyzed in isolation. A strong asset in a weak market is vulnerable. A strong asset in a strong sector has fuel. So step 1, market direction. Before we care about any asset, we ask, is the market giving us the green light? And the way to do this is to use the S&P 500. We'll look at that in a second. But ultimately, the S&P 500, the NASDAQ, the Dow, these are indices. And what they're great for is giving us the overall market direction. They're kind of like the barometer or the thermometer of the market. If they're bullish, then we know the market overall is bullish. So we know now that the S&P, the NASDAQ, and the Dow, they're all setting record highs. That's a clear indicator that we're in a bullish market. Then we go to sector strength. Step 2, the strongest assets usually come from the strongest sectors. This is where institutional capital is flowing. So we often hear people wanting to trade like institutions. That's not what you want to do. As retail investors, we don't want to trade like the institutions. What we want to be able to do is identify where they are, and that's where the trends are coming in. We then want to jump on their back and piggyback the ride. Ultimately, we want them to do the hard work. We just want to ride the trends and collect the money. So we want to be aware of where they are, but we want to have our own process to capitalize on that. And to do that, I have a 2-tier filtering process. So we do not just jump from a ticker idea straight into a position. We separate the discovery from the decision making. So there is a process to this. So tier 1, I use a scanner. I use MetaStock. which is the scanner that I have been using for many, many years. I know that there's numerous scanners out there. Some of them are free, some of them are expensive. Usually you get what you pay for, guys. So any sort of free scanners or cheap scanners, I can tell you, are very limited in their capabilities. What you want is a decent scanner that gives you full control over what you want to program into that scanner. And these aren't inexpensive. You're looking at maybe $75, $100 a month, which, you know, is the equivalent to a gym membership, or how much money people spend on coffee when they go to Starbucks in a month. You know, this is an affordable amount. Ultimately, going back to what I was saying during my photography days, I understood the importance of investing in good equipment, because if you want to deliver for your end client, you've got to have the right camera, you've got to have the right software, you've got to have the right lighting, the right editing rooms, the right studio. If you don't have that, you won't deliver for your clients. In this case, your client is you. So you've got to be able to deliver for yourself. And to deliver for yourself, you've got to invest in good equipment. And technology today is a game changer. So we use a really good market scanner. And that allows me to go through 20,000 assets. That's US stocks, UK stocks, commodities, and currencies, which are the main markets that I look at. And that's roughly around 20,000 assets. I program the scanner to look for a particular criteria every day. And it usually gives me between 50 to 500. On a normal day, around 100. On a quiet day, less than 100. On a very busy day, it can be 3, 4, 500. But on average, 100 to 200 is a good list. What I then do is I take that list and I do a manual analysis. And I'm looking for the 10 to 20 high probability quality stocks and assets that make it into my portfolio. So only the very strongest setups that I move forward with. Now, here's the thing. Every stock or asset that makes it into my portfolio must meet a 16-point checklist. Part of that checklist is done by the scanning. The other part is done by the manual analysis. So by the time that asset gets into my portfolio, it has met a 16-point checklist system. And I'm going to show you in parts how that looks. Step 3 is relative strength. We don't want cheap stocks. We don't want popular stocks. We don't want opinions. We want leaders outperforming the index. So if the index moves up to 20% or 30% in a period of trend, we want stocks that move up 100, 200, 300%. So how do we do this? Well, I've created a system called the 4PS method, and this is all part and parcel of what goes into the scanning and the analysis. Every stock I invest in follows a particular process. Think of it like a flight of steps. Every stock I invest in has a step-like structure. It moves up, it flattens out. It moves up, it flattens out. It moves up, it flattens out. Every time it moves up, it can be for 12, 18, 24 months. That's when we want to be invested. When it flattens out, we either hold or we take our profit. Then we wait for the next uptrend and invest more. Now, when one stock starts going sideways, another stock will start moving up. So that's where that sector rotation comes in. So this is what I call the 4-phase sequence method, or the 4PS method. The structure we want before any capital is committed. When I'm doing the manual analysis, what I'm looking at is if the stock has a proven performance history. What I'm looking at is at least 12 to 18 months of trend. This is why I like stocks with at least 5 years of history, because with at least 5 years of history, I can analyze those stocks and I can then look at those stocks to see if there have been any trends. If there haven't been any trends, I can dismiss them. What I'm then looking for is a phase 2 consolidation base. I'm looking for a sideways market. Remember that expression, guys, the longer the consolidation, the bigger the breakout, right? People know these expressions, but they don't execute them well. What I'm looking for is a base of at least 3 to 6 months, often longer. Then I'm waiting for that breakout. Now, remember, that first breakout could potentially be a fake breakout. So you don't want to jump in on that first breakout. It's phase 4. Once that new trend is confirmed, that is when I enter into that particular stock. So my portfolio is full of phase 4 assets. When gold is a perfect example. I held gold from March 2024 up until January of this year, so almost 2 years. When it broke out in March 2024, that was its phase 3. Phase 1 was from 2001 to 2010. Phase 3 was from 2011 to 2024. So that was a 13-year sideways market. Look at it on the monthly time frame, guys, when you have a moment. Phase 3 was the breakout in March 2024. And then it was around April, May, where it confirmed phase 4. And that's when we started taking positions. And then we held that all the way through to January of this year. So you can apply that across the board. Now, the setup quality, step 5, setup quality. Not every breakout deserves your money. We want the strongest assets breaking out from the cleanest setup. So going back to what I was saying earlier, just because it's moved from phase 2 to phase 3 doesn't mean that you want to jump into that stock. You still want to do the analysis on the quality of the breakout. Maybe it's not the first breakout you want to enter in on. You want to wait for the second or the third breakout to allow for that trend to develop, that what we call bull flags. So if you're waiting for bull flag formations, once we've had a first or second bull flag, then we can start considering taking a position. Next up, stop loss placement. Before we care about how much we can make, we need to know exactly where the setup could fail. And this is really, really important. No stop, no trade. Remember what is under our control. Everything that we have done up until now is under our control. The only aspect of a trade that is out of our control is the outcome. We have no idea what a trade is going to do next. Hence why we're always looking for probabilities and that edge, because when we take that investment, when we take that investment, we want to make sure that that edge is in our favor. So we have more chance of making profit than a loss. But if it fails, because it's an edge, it's not guarantees, we need to know exactly where that's going to fail. So we need to ensure that we have a stop loss on every single trade. Risk allocation. We want enough size to matter without enough risk to become emotional. You don't want to be putting 5, 10, 15, 20% on a single asset. A good setup with poor risk is still a poor trade. So I typically don't risk more than 1% per position. Sometimes 0.5% if I'm just testing. In very strong market conditions, I might add 2%. But 1% is a good amount because it allows you to test the waters and it allows you to spread your risk. So you can take 10 1% positions or 10 different stocks. You're testing the waters, cut out of the ones that fail, hold and compound the winners, so on and so forth. Losers get removed quickly. Small losses are the cost of admission. Large losses usually come from hope, hesitation, and ego. Hope is not risk management, guys, right? We have to get rid of that idea of an emotional attachment to anything that we do. Hope is not risk management. Step 8, this is really the key to wealth creation, compounding winners. The real money is not made from being right once. It is made from adding strategically to proven winners and letting trends do the heavy lifting. We add to strength because the market is already proving the idea right. So as the stock keeps on returning a profit, keep adding 1% positions. So keep on buying 1%, 1%, 1% more of a winning stock. So this way you're keeping your risk low, but you're winning, you're adding more of a winning position, which means you're exponentially growing your upside. So your downside is fully protected with your upside uncapped. Compounding is an absolute must. I can't stress that. Exit management. This is where most investors fail. They buy well, then butcher the exit. We use a trading stop loss matched to the asset's volatility. So every stop loss should be unique to the asset. Because let's say an asset moves 100 pips a day on average, another moves 200 pips a day. You want a stop loss that takes that into consideration. The exit protects the compounding as well. So what I mean by that is when you add more of a winning position, all you need to do is remove the risk on the previous position. So you're adding more 1% positions without adding any more risk into your portfolio. Okay, so this is how a portfolio compounds. Find strength, enter with structure, define the stop, cut weakness, protect capital, add to winners, let trends do the work. Knowing what works is not enough. Most investors do not fail because they lack information. They fail because they lack a repeatable execution process. Information is everywhere. Execution is rare. The real problem actually is consistency. Can you scan consistently? Can you filter objectively? Can you avoid weak assets? Can you hold winners? Can you exit without emotion? This is where investors ultimately break down. They start with good intentions, headlines get noisy, markets pull back, confidence drops, rules get ignored, profits get butchered. Without a clear strategy, behavior then becomes the problem. So this is the weekly routine. Check the index, check sector strength, run the Sublime scans or any scans that you're running yourself, review the shortlist, confirm setups, manage entries, stop losses, winners, compounds, and exits. It's simple enough to follow and strong enough to matter. So this is the outcome: a cleaner watch list, better timing, more confidence, no noise, a stronger portfolio process. Confidence comes from process. Okay, so now let's see the process in TradingView. You've seen the workflow. Let's apply it to some real examples. So if you just bear with me a second, I am now going to move over to TradingView. And I think you guys can see that I'm just looking at the charts within the platform. So I'm going to just dive straight into TradingView. Okay, so let's start with the S&P 500. This is a typical chart setup of mine. I've got the monthly in the top left, I've got the weekly in the top right, and I've got the daily chart across the bottom. Notice the time frames that I'm looking at. I'm looking at the higher time frames. The no intraday time frames, only the higher time frames, because that's where I can do less work for more profit. Also, what this allows is that I only then need to look at the market once a day, which is at the end of the day. And that's great because then we can just get on with our lives. We all have businesses, we all have families, commitments. We like to go to the gym, hobbies, friends. We've got stuff going on. What we don't want is then to be glued to our mobile phone apps just because you've got some day trades on and you're completely disconnected from what's going on around you. We have to be smarter than that. So I look at the higher time frames. Now, what I'm looking for is alignment. I want the monthly, the weekly, and the daily to all be aligned. So on the monthly, I have a very clear indicator. I have the highest, if I just open up the monthly time frame, I have the high of last year, this green line right here. You can see that this in March, this was the correction in March when everyone was saying, hey, the market's coming to an end. This was, obviously being connected to what was happening in the Middle East and with Iran. But you can see that the following month, it all got absorbed into the market, recovered, broke out above the high of last year, and that has just continued. So everyone who's holding short positions or closed off their positions in fear have now missed on that subsequent rally and more profit. And this is what I mean by staying aligned and just allowing the market to do what it's doing. In reality, all we have here is a seasonal correction. At the start of the year, there's always a correction, typically February. February is the weakest month of the year. For February and September, the two weakest months of the year. This month it was March. Why? Well, the markets do what they do, but what we can expect is some kind of correction. We had that correction. The market has since recovered. It's now above the high of last year, suggesting that we are in that bull trend continuation. If we go to the weekly time frame, very simple markers, 250 simple moving averages, and I have a trend filter. You'll notice that the trend filter is either green, gray, or red. If it's green, we're in a bull market. If it's gray, we're in some kind of pullback. If we're in red, then it could be the start of a bear trend. Now, normally a bear trend for me is below the 200 simple moving average on the weekly time frame. And the reason why I say that is because the last time the 200 simple moving average was broken was in 2008. Surprise, surprise. And before that, 2000. So tech bubble in 2000 and then 2008 during the global financial meltdown. Since then, and that's the recovery, since the recovery and it moved above in 2010, the 200 simple moving average has been used as an area of support. Apart from that little blip around COVID where it dipped below it and then rallied straight back up again. But you can see for yourself, 2011, 2016, 2019, 2022, 2025, it's continuously come to the 200 SMA and bounced. So we really want to be aware of that. So on the weekly, above the 50, above the 200, the trend filter is green. So we're clearly bullish on the weekly. And on the daily time frame, what we have are the 200, the 50, and the 20 simple moving averages, and the trend filter as well is green. So what we have is alignment. My tools are telling me that the market is aligned. And that is enough for me to know that we're in a bull market. Now, in addition to that, you can see these little green markers. What these green markers are, these are breakouts. So when we start getting large number of breakouts, what that's telling us is that the market is producing bullish flags, and bull flags are trend continuation patterns. So since April, mid-April, we've had 1, 2, 3, 4, 5, 6, 7, 8 bullish flag formations. If we go back to this area here, look at, this is the recovery from the Trump tariffs, April 25, to this area here, which is October 25. Look at how many breakout signals we had. So we are very much in a bull market. And so this goes back to what I was saying at the very beginning. You want to be aware of what the S&P 500 is doing. Once the S&P 500 is doing what it needs to be doing, which is aligned, the weekly, daily, monthly, weekly, daily aligned, we can then start looking at stocks. So let's have a look at some of the stocks that have been picked up by the scanner and that we have invested in over the last 12, 18, 24 months. Notice Seagate Technology, STX. This stock has climbed since April 25 when it broke out and set record highs. This is phase 4. It has climbed 664%, so over 650%. If we look at the S&P 500, so this is going back to May of 2025. So if we go to the S&P 500, if we go to May of 2025, which is this bar right here, the S&P 500 has climbed 28% in comparison. So this is what I mean by finding stocks that are outperforming the index. You want to be able to find stocks that are leaders that outperform the index so that you can get in early, ride the trend up, and then achieve far superior returns. So notice it was in January of this year, it moved above the high of last year. The S&P 500 only broke above the high of last year in April. We're in June now, in April. Whereas the STX broke above the high of last year in January. So January, February, March, April, this was leading the index by 4 months. On the weekly, above the 200, the 50, and the trend filter is green. On the daily, above all 3 moving averages, and the trend filter is green. Now look at the number of breakout signals, the bullish flag formations, these green markers that have appeared. Look how well it's supported by the 20 and the 50 simple moving averages. This is what makes a very clean linear trend. Sorry, excuse me, guys. This is what makes a very clean linear trend, one that's supported well by the 20 and the 50 simple moving averages, and it's only continuing its run to the upside. Okay, let's have a look at another stock. And I'm going to give you a stock that you want to be looking at right now because it's only just starting its next uptrend. And that is, of course, NVIDIA. Now, NVIDIA is a really good example of a stock that moves up like a flight of steps. Like I said, it's up, flat, up, flat, up, flat, up, flat, up, flat. And it's now starting its uptrend. It's above the high of last year. It's above the 200 and the 50 simple moving averages on the weekly. The trend filter has turned green. And now on the daily time frame, it's above the 200, the 50, and the 20 simple moving averages. The trend filter is gray. What we're waiting for now is the next breakout signal. So you can see that we've got a number of breakout signals. These are the ones that I have ignored to avoid the fake breakout. And the next breakout is when I will start taking positions in NVIDIA. Now, I actually have positions running in NVIDIA since early 2023. So new positions that I will be adding are actually going to be compounds. And we've done this across the board, guys. I'm just going to share a number of stocks that we've done this with. Curtiss-Wright. Strong stock that's moved exceptionally well. Amphenol has performed very, very well. It's currently going through that flat market like I talked about, up, sideways, up, sideways. We're now waiting for the next breakout and continuation. Now, stocks that have not worked so well, Rollins. This was a stock that I took recently and it failed and it reversed and it stopped me out. So not every stock is going to work out. All we do is we focus on the winners and we hold and we compound the winners. The ones that fail, we simply cut out. Now, how do we know when to cut out? That is where the trailing stop loss comes in. So I've just moved across to the other chart and you can see that we have, let me go to Rollins. So it was around this area here where we took positions. And then once it started walking along the lower Donchian as an example. Now here we're using Donchian 20, just to give you an example of a stop loss that you can use. I don't personally use Donchian 20. I have a proprietary stop loss that's based on average true range. But Donchian 20 works very, very well as a stop loss because it allows, if we go to STX as an example, you can see how well, when it trends, how well it walks along the upper channel And then when it tags the lower channel, that is when you can exit. So you can see how well, if you take this area here, April through April, that's April 25, all the way through to March 26. So you're looking at around a year of really, really good trend before it tagged the lower Donchian. So Donchian 20 is a very, very good example of what you could use as a trading stop loss, because it has that nice balance between allowing winners to run, and then when it tags the lower Donchian, you can exit your position. Now, with each marker, I have an entry and a stop loss. This is created by tools and algorithms that we have developed. So whenever there's a green marker, an entry and a stop loss will be produced. All I need to do is take that entry and that stop loss, put it into my broker account, work out the number of shares that I want to risk, that 1% risk allocation between the entry and the stop loss. I take a market order. I take an entry order, and I then wait for the market to take over, trigger me into that position. If I get stopped out, I get stopped out. If I don't, I keep on, I hold, and I keep adding and I compounding until eventually it hits my trading stop loss. Okay, guys, I'm just conscious of time, so I'm going to just quickly move on to the final slides that I want to go through. Okay, so excuse me. Okay, so what you saw this whole process that we went through, from market all the way through that, looking at the S&P 500 to sector to asset to setup, entry, stop loss, risk compounding, and exit. We just gone through that whole process. What we saw was market direction. We then went through sector strength, asset selection, setup quality, entry, stop loss, risk compounding, exit management. Ultimately, that whole 16-point checklist system is broken down into this flow and this process. That is the difference. Most investors are looking for tips and shortcuts. This process gives you a repeatable way for identifying strength, managing risk, and compounding winners. So what happens next, guys? You can keep trying to piece the market together yourself. You can take away everything that I've shared with you today and of course, try and figure it out. Or you can use a structured system built to identify strength, manage risk, and compound winners. We've already done the hard work, guys. All you need to do is basically learn it and put it into process. You can figure this out, but I can tell you it will take a lot of time and a lot of money. For us to get to where we are today has taken an immense amount of energy. So we will save you that. The wheel is already in motion. You've just got to get the wheel working for you. So to do that, we've got a great offer. We'd like to invite you to the APL monthly subscription. This is our copy service, the asset position log. This is a process-led portfolio workflow designed to help investors follow high-performing assets with clear entries, stops, risk, compounds, and exits, built for investors who want portfolio decisions, not predictions. This is what it looks like. Ultimately, you'll have information on all the stocks, which sectors they're in, how much we're risking, where we're entering, where the stop losses are, how old the trend is, because often what people will do is they'll watch, then they'll get in because FOMO takes over, and then the market reverses because they got in at the wrong time. So we will guide you through all of that to make sure that you're getting in at the start of the trend and exiting when you need to. So what you get full access to the copy service. That's through the desktop and an app. Instructional videos on how to use it, fully explained. End of day positions. We do the scanning, the analysis, that 16-point checklist. We do that every single day, and then we send out a notification for you every day. So not only are we saving you money for the scanner, but we're saving you around 1 to 2 hours every day at the end of each day, finding these opportunities. You understand the process through the instructional videos. We do the process for you. Everything is shared, from entry, stop loss, risk, and compound levels, position management rules. So when we tighten stop losses, when we exit, when we compound, that's all shared. You get a private community as well to discuss positions. And of course, there's onboarding support. This is normally $249 a month. But for the first month for you guys, it's $199. You just need to go to apl.sublimetrading.io, use the code MAD50 to get $50 off the first month. Usually what happens, guys, is that people come in for the first month. If they like what they see, they then move on to the annual subscription. The annual subscription, you get 40% off, because ultimately this is a trend following process and we want people to commit to the process. So if you're going to commit to the process, we'll give you a nice 40% off on the annual subscription. But to test the waters, it's $199 for the first month using that code MAD50. So what the APL actually does, it turns decades of market experience into a repeatable portfolio workflow, saves hours of manual scanning, filtering, and portfolio tracking, because we'll do that for you. Helps you avoid weak markets, weak sectors, and weak assets, because we're only sharing those that we are watching, entering, holding, compounding, and exiting. Ultimately, the strongest stocks in the strongest sectors. Gives you a process you can follow, refine, and eventually pass on. No noise, more process, better decisions. So this is not just a spreadsheet, guys. It's a spreadsheet that records information. The APL turns a process into portfolio decisions. That is the difference. Data is useful. Process is what compounds. So who is this for? Investors who want structure, investors who want to stop guessing, investors who want portfolio decisions they can follow, investors who want to build serious long-term portfolio, serious investors, serious process. This is not for day traders, top callers, bottom guessers, signal chasers, anyone looking for a magic button. This is not entertainment, guys. This is an absolute proven legacy process. And there you have it, guys. This APL gives you the process investors are missing, not because it predicts the market, because it gives you a repeatable way to follow market strength, manage risk, and compound winners. Edge is not a feeling. It is a defined process. So the truth is, the simple proven process creates the biggest long-term impact on your financial success and stability. And there you have it, guys. I will.
All right. Well, thank you very much. Let's see if anybody has any questions here. Let me pull up the question box. To take advantage of Zaheer's offer, the link is in the chat box on the right. You see sublimetrading.io/bonus. Click on that. That'll take you to the dedicated sales page, which is only available today. So thank you very much for joining us today. I'd love to have you back in the future. Very intelligent presentation, and I actually learned some new things myself.
Thank you, John. Appreciate it. And again, congratulations on your 25th anniversary.
Well, the harder I work, the luckier I get.
Well, I mean, that's the magic formula.